Why US dollar rates lower than Kenya shilling rates? My name is Charles Miano, Senior Investment Analyst, Nabu Capital. I'm sure you've asked yourself, why are US dollar rates typically lower than local currency rates? So in particular, if you're looking at dollar rates, you'd see rates, let's say, below 3%, and then Kenya shilling rates something above, let's say, 8%. So there are a variety of reasons why you see that difference. And I'll go through three particular reasons why there is that difference. The first one is in regard to the demand of the currency. As we note, the US dollar is a global currency, and it is the de facto or the premier currency of our world, especially when it comes to transactions all over the world. So the demand on that particular currency is relatively high, given that it is used to price different goods, services all across the world. So the demand on the currency is relatively high compared to, for example, using the Kenya shilling, which is a local currency. So compared to those two particular currencies, the demand in the dollar is higher than of the Kenya shilling. So given that difference in demand, and given that difference in demand, the higher the demand, the stronger the currency, or the stronger the value of that currency. And we've noted that with that strength in the dollar, it tends to attract relatively lower rates or relatively lower interest rates in particular, compared to interest rates that you would see with the Kenya shilling. So for that particular reason, the dollar has a lower interest rate compared to the interest rates that you'd earn in a Kenya shilling opportunity. The second thing is in regard to inflation. Basically, inflation is the persistent rise in the value of a certain good or service. So the US has inflation rates particularly lower, sub or lower than 2%, compared to Kenya's, whose inflation rate ranges between 4 to 8% over the last 1 year. So with the difference in inflation rates, it brings what we call differential. And with that differential, a country which typically has lower inflation has lower interest rates, and a country which has a higher inflation has higher interest rates. So there's that relationship that comes that defines those two when it comes to inflation as interest rates. So the US has a lower inflation, therefore it attracts lower interest rates, and Kenya has a higher inflation, and therefore it attracts higher interest rates. And the third point is monetary policy, and the monetary policy is determined by the central bank in different countries. For example, in the US, it's determined by the Federal Reserve, and in Kenya by the Kenya Central Bank. And in this case, just to give you an explanation of what that means, is whenever the central bank wants to influence how much money is in supply in the economy, they either increase rates or lower rates. When they increase the rates, they want to reduce the amount of supply in the market. When they're reducing the rates, they want to increase the amount of supply in the market. So it's an inverse relationship. So in this case, what we saw after the pandemic is the US Federal Reserve reduced the rates or cut the rates in order to increase the amount of money supply in the market. So they reduced the rates all the way to around 0% levels. And we've seen a similar thing, for instance, in Kenya, where the rates have been cut throughout 2020 and are currently at 7%. And so with that impact, what happens is there's demand for the bonds, and demand for treasury bills and treasury bonds. So whenever there's high demand, the price of that bond goes, the higher the demand, sort of the lower the price. The lower the price, particularly when it comes to interest rates for the bond. So what we've seen is with that high demand, we've seen interest rates for bonds, especially in the US market, go very low. So we saw, for example, the 10-year bond go from 1.2, 1.3% levels all the way to about 0.2% within this period since the month of March. And also we've seen sort of similar trends in different markets. And so this, by explaining how the rates have, for example, the 10-year bond moved from 1.2 all the way to 1.2 all the way to 0.2% or so level, it explains or gives you a sense of why we see the dollar rates very low compared to maybe a Kenya bond, where the 10-year bond is currently at around 11%. But even before the coronavirus, before even the central bank cut rates, it was around 11.5%. So it hasn't dropped significantly and it's remained fairly within the same range. So that just gives you a sense that as long as there is significant demand in the US dollar, as long as there's a difference in inflation rates between Kenya and the US and the United States, and as long as there's a difference in monetary policy between the different countries, then you will see a difference in how much interest rate or how much return you receive for your investment. And therefore those three reasons explain why the US dollar rates are lower than the Kenyan shilling rates. Subscribe to learn and make informed investment decisions. And in our next video, we shall be answering the question, how do you start investing in the US dollar?